Hey everyone, welcome back to another episode of the Integrating Investor. I'm Seth Levine of the Integrating Investor. As you know, I am thrilled to have you here today. We have a fantastic guest who we'll be talking to, Corey Hoffstein of Newfound Research. As always, with all our guests, just note, of course, this is not philosophy, of course, but we are going to be talking about, how he developed and thinks about his investment framework, and that ultimately leads back to his views of the world and how he thinks about the world, which is, of course, philosophy. But I think Corey does a lot of interesting research into kind of the composition of investment markets, which is a little bit different than some of the other guests that I've had. As always, please like and share this episode. Get the word out. It really helps a lot. You can follow me on Twitter, Instagram, if you're into that, and all that good stuff. And of course, sign up at my website to subscribe to get my monthly emails and articles right into your inbox. And because we have interview guests, please, take the opportunity to use that super chat function to ask Corey your questions. He is going to graciously answer them. And as always, if you have any questions or show guests or show topics, please email me at info@integratinginvestor.com. That's info@integratinginvestor.com. So without further ado, we'll move on to the most fun part of the show, the disclaimer. Especially today, please note, these are just personal opinions. There is no investment advice being discussed on this show. Do not construe our comments as such. This is not an offer to buy or hold any securities. There may be conflicts of interest. Corey or I may hold specific positions. Do your own work before investing. You guys all know the drill, and we'll move on from there. So, without further ado, everyone, we are joined by Corey Hoffstein. Corey is the co-founder and chief investment officer of Newfound Research. Newfound Research is a quantitative tactical asset management firm that was founded in August 2008. Corey is responsible for portfolio management, investment research, strategy development, and communication of all the firm's views to clients. Corey has a real impressive background too. He has an undergrad degree in computer science from Cornell University and a master's in computational finance from Carnegie Mellon. In addition to his firm, he produces a couple really high quality podcasts that I really enjoy. One is Flirting with Models, where he interviews quantitative investors that you don't typically hear from in these formats. So I find it really interesting, especially coming from a fundamental background. And of course, just Flirting with Models has, maybe one of the best, one of the best podcast titles out there. He also co-hosts Pirates of Finance or Pirates of Finance, depending on which side of the tracks you live on. And that is an open-ended exploration of various investment topics. Pretty interesting. You can find Corey on the podcast circuit as well, or you could just read his super interesting research that he makes publicly available on his website. Corey's another one of these good guys of FinTwit. He's very approachable, very down to earth, super smart, and he also may be one of the most dapper dressed guys in the industry. But I'll save that up to you to determine. Corey also builds. Many people don't know this. He also builds a killer gingerbread house. So with that, it's my pleasure to welcome the second pirate onto the Integrating Investor show. Corey Hoffstein, thank you for joining us. Welcome.
Seth, thank you for having me. I'm going to have to hire you as my hype man. Normally I hear someone give my background and I'm like, that sounds like the most boring person that could possibly be on a podcast. But I feel like I'm excited to hear myself talk now.
Yeah, well, I'm just geeked up for this stuff. So I love just digging into kind of thinking. I love digging into investing, and I love the people who I've met kind of along this journey. So,
and I'm excited to share my top gingerbread house tips. I know that's what we're going to go into first.
I mean, ultimately, I'm going to save that for the end just to keep people sticking around, because I would like to get into this year's design. And if you guys don't know what I'm talking about yet, you will by the end of the episode. So please stick with us. So Corey, one thing I always love to do first is just to dig into people's paths, kind of hear what brought them here and how that kind of shaped their thinking about investing. Mind kind of giving us yours?
Absolutely. So I like to just admit upright that my journey into finance was more or less accidental. I actually, at a very young age, learned to program. My father was an entrepreneur who sold computers. So I always grew up around computers, had computers in the house from a very young age, loved video games, and started learning to program when I was in 6th or 7th grade because I wanted to make video games. Ended up coding all throughout high school, ended up going to college for computer science, and very quickly realized, oh, I don't want this to be my career. I love coding. It was something I'm super passionate about, but man, the idea of sitting behind a computer and writing code all day with the peers I was in class with really was not particularly exciting to me. And so it sort of like put a really quick stop to what my plans had been. And so I just started searching around, and that was 2005. And at least in that era, a lot of my friends were starting to look towards investment banking and finance. Those were like the really hot career tracks after the dot-com fallout. And so I think I just started to get interested in finance at that point. I was very fortunate that my father's financial advisor was able to make a number of introductions to me, to people in the industry. One of my earliest internships was with a small fundamental equity manager who my summer project was to basically use my computer science background to take all of what he knew qualitatively and try to not just test it quantitatively, but then build a proactive screening system. So really my back end way into finance was that I was using my computer science knowledge as a tool. It wasn't that I was super excited about the finance side. It was just that, wow, this is a really interesting way to automate and test what someone is doing more on a discretionary basis. And then where I really sort of lucked out was that I was working on some models for myself just in my spare time. They were highly tactical in nature. 2008 comes around, and I ended up getting introduced to an asset manager who saw what I was working on and said, that looks really interesting. The type of tactical signals that can tell you when to go to cash or when to hold equity. Would you be open to licensing your research? And I was a broke college student and I needed beer money. And I said, absolutely. So I named my company Newfound Research. Newfound is the name of a lake I grew up on, and research because I was providing research. I fully expected the company to shut down within a year. 13 years later, we're still here, still doing it. Certainly an evolution since then, which we can get into. But I ended up going to grad school. Thought I would go, at that point, it was like 2009. Thought I would go work at a bank. The grad program I was in was all about pricing derivatives. Figured I'd go work on a credit default swap desk or something like that. Those jobs completely dried up. Fortunately, the asset manager who was licensing my research at the time really was able to hit the market hard and had raised over $1 billion. And I said, there's a big appetite for the type of research that I'm generating with my signals. I'd love to keep doing that. I have that entrepreneurial spirit. Now is just as good a time as any to take the leap. And so I took the leap and haven't looked back.
That's incredible story. So basically you've never had a W-2 employment slip in your life, huh?
I am the least hireable person in the world because I've never had a real job other than like those jobs I had in high school, sweeping floors and stocking shelves.
Yeah, hey, there's a lot to learn from there. That's a pretty interesting background there. I mean, did you even know, because I have there's definitely some similar or experiences that I share, I guess, with you. The first is, we had the same undergrad, and I remember taking a computer science class because I was an engineering major, and I was like, "What is computer science?" And I looked around. It was maybe one of the hardest things I ever did. But then I remember too, I'm just a couple of years older than you. You had all these friends who were going into finance, investment banking, and equity research. And I was like, I never heard of these things before in my life. I was like, what are these things? But everyone was going into them. Did you know anything about that before you sort of pivoted down that path, or was it just,
You
hey,
know, I knew about markets generally because through my father. I was very fortunate. Again, he was an entrepreneur, so he was always preaching about entrepreneurship. He was a lifelong investor, so he got us at a very young age. I don't want to say tricked us into investing, but he basically said, look, any dollar that you decide to invest in the stock market, I'll match. Right. So at a very young age, we were incentivized to not just save, but to invest. Now, we weren't allowed to take that money out until I think we turned 18. And I think it was like a low risk gamble for him because how much can a 12-year-old really save? Right. But so I sort of learned what the stock market was. But investment banking, I mean, again, all my friends at Cornell at the time were going to get jobs at JP Morgan in their iBanking or Goldman Sachs. Like that's what everyone was trying to go do. And I candidly had no idea what any of it was.
Yeah, I'm like, I was just shocked. Like, how did these people even know what these things are, right? And I kind of found myself into the industry as well, obviously. So that's interesting. So basically, you had this love of computers, and I guess you were in search of something. You basically had this tool set that you developed, a very powerful tool set, and then you were kind of in search of an application for it. Is that kind of the right way to think of it? And
yeah, I think that's right. I mean, I hate to say it was almost 20 years ago, but you rewind the clock 20 years ago, being able to program was still a unique skill. And I think it's a much more common skill now, which is a good thing. I think it's an incredibly powerful skill. But 20 years ago, to be able to take almost any idea and know how to code it up and test it and automate, I think was just something that differentiated me from a lot of my peers. And it was something I loved doing. So it really was, I had this skill set. Markets, once I got introduced to them, were intoxicating in terms of, wow, there's so much new stuff to learn and figure out. And I bought every book I could and read everything I could. I mean, it's such an amazing, mysterious machine that I don't know if anyone can ever truly figure out. And so that part was very enticing. And then it was really just about sort of marrying those two passions.
Gotcha. Yeah. So how did you go from, I mean, there's like a period there that you kind of just gloss over, which is interesting. I mean, not on purpose per se, but you go from basically being in college, in an internship, to developing market signals, right? Where did you get the ideas for these market signals? How did you devise your own? I mean, the programming side, I imagine, is pretty straightforward, but the whole, trying to, signal search and how that framework, what signals are you even looking for? How did you develop that without any, training or any, education?
I think I went down every path you kind of can, given the data I could get my hands on. So I mentioned I did the internship with a asset manager who was more discretionary. Well, he still had access, I think it was CompuStat at the time, to 20 years of point in time fundamental data. So I was able to get my hands really dirty there. And a lot of what I was doing was, in hindsight, very rudimentary statistical tests. I didn't know that what I was doing was actually factor investing, but I was looking at different characteristics. I'd have a hypothesis that if you buy stocks with this characteristic and rank them and sort them and build the portfolio, this quintile should have a premium over that quintile. I did not know that was factor investing, but that's what I was doing, a rudimentary version of that. But at the same time, I was testing all sorts of technical indicators, right? I think one of the nice things about being young is you're very naive. And it means you're very open to exploration in a way that I think when we get older, we get very cynical. And that can both be good and bad. It can help you just filter out a lot of noise. But I think it prevents you from exploring some new creative things. And so for me being young, it was, I don't know any of this and I don't know any better. So I'm going to go down every avenue. What really kicked off part of the exploration for me, though, beyond the internship, was another sort of internship I was doing at the same time. I was sort of interning at two places, was with my father's financial advisor. I was just sitting in on meetings with asset managers who would come in and pitch him so I could learn. And there was one particular manager in 2007. I was a small cap value manager. And before the meeting started, I'm sitting with the manager and I'm just trying to waste time. And so I asked like the very cliche young person question of like, what do you think of the markets? and I will never forget, this manager proceeded to give me the most bearish outlook for the markets I'd ever heard. I mean, not that I'd heard many outlooks, but it was like, it was summer 2007. And he was laying out this like massive housing crisis. And it was the first time I had heard any of this. And I'm like, wow. So what are you going to do about it? And he's like, oh, nothing. My job is to provide small cap value exposure. I got to be 95% invested at all times by mandate. And candidly, I don't even know who's invested in my portfolio. The money just comes in. I don't know whether the risk is right or wrong. Who is it? You know, who am I to say I'm going to take this portfolio to cash, right? When they could be doing that in other parts of their portfolio. They come to me for small cap value exposure. That's what I'm going to give them. I said, okay, that's actually, I get that.
It's such a common, perspective. And it's one I truly understand, kind of being on that side, but
yeah. And so I was like, that makes sense to me. And then after the meeting, I went to my father's financial advisor and I said, well, here's what this person said. You know, what's your opinion? And he said, well, I think that's crazy. How am I supposed to know when it's a good or bad time to invest in small cap value? That's why I'm hiring an expert. If he doesn't think it's a good time, he should be the one going to cash, not me. And I sat there going, well, that's also an answer that makes a lot of sense, right? You're outsourcing this to an expert, and the expert's saying, well, I don't know what you're doing with the rest of the portfolio. And you're saying, well, I don't have the insight in each slice to know what to do. And they're both pointing the finger at each other as to who was ultimately going to manage what I thought was the biggest risk, which was drawdown risk. And so I looked at the amount of money I had invested in the market, which at the time was all of my life savings. And I said, I'm going to lose all of this unless I figure out, you know, how to manage risk, because this guy scared the pants off of me. And I started looking at all sorts of different signals that were ultimately market timing signals to some capacity. And, you know, in hindsight, again, they were just the very cliche signals: valuation, you know, market breadth, tons of technical indicators. And what I ultimately ended up finding was that trend following for me, and I didn't know it was trend following at the time, but those signals that I developed ended up being the most robust that I could test. And then there were some certain ways, and I'm happy to go into this, that I was adding my own unique spin on it based on other things I had discovered that differentiated it from a traditional trend following system. But at its core, they really were trend following signals. And, you know, it was mostly based on that time, the different sectors of the S&P 500 was the real focus. And I remember back in 2008, almost all the signals were off except for the energy sector. And my father's financial advisor was actually using some of the signals with some of his clients. And I must have been 20 at the time, turning 21. I'm panicking that there's real money besides my own tracking this stuff. And I'm like, oh, it's got to be wrong because the energy sector is still on. All these other sectors are off. And then all the sectors went to cash, and they were in cash, I don't know, until early 2009. And, you know, those were like live signals with money actually tracking them in late 2008, early 2009. And I was like, wow, that was unbelievable. And it may have been the worst thing that's ever happened in my career. because when you have a really strong success out of the gate, you become anchored to what you're doing. And you go, well, it worked. And so you trick yourself into believing it's going to continue working. And I think I became far too anchored to trend following for far too long, but that's a whole other philosophical topic. Yeah,
that's very interesting. And something that comes up a lot, you know, it's kind of that early success. It works in both ways, because in a lot of times it keeps you hooked in a certain way, right? It keeps that fire underneath you to keep going down the path that you're on. But again, it kind of can lead to an overconfidence bias, or however you want to characterize such a thing. So I'm curious, so what were those unique spins on your initial strategies? And kind of where did you get them?
One of the I don't know, you was something else.
No, go ahead. Yeah.
So one of the things, again, when I go deep into a topic, I end up like going down the rabbit hole, probably way further than I should. So when I talk about like when I started getting involved in markets, not only did I read every book I could get my hands on, but I was also deep in the weeds of like reading every message board out there, for better and worse. There's some really brilliant message boards at the time that were out there that were really sophisticated quantitative people. And then there were some really crackpot message boards, and I didn't know how to discern which one was which. So I'm taking information from everywhere. And one of the things that was being discussed, and I think it was on one of the more quantitative message boards, was this idea that if you took market returns and then divided them by sort of the current measure of market volatility, that result looked a lot more like a normal bell curve than if you just looked at market returns, which tends to be fat-tailed, right? So this idea, and the underlying idea there was, at least the way I saw it, we measure market returns with respect to when the market opens and the market closes, right?
Right.
Or we do close to close, but it's on a clock based upon, the Earth turning on its axis, which is pretty arbitrary when you really think about the way the business cycle works, right? Sure, there's seasonal elements we can go into, but the reality is like companies issue information at different points. Information comes to market at varying speeds, and that information is of varying magnitude. And so to constantly measure over a fixed period of time, when you think about it another way, is saying, I'm going to actually measure a varying amount of information. And so
just taking a snapshot at a seemingly arbitrary period of time.
So my, like, the way I would say this is, there was probably more information in a single month in 2008 that was relevant to what was going on in the market than the entire year of 2007.
Oh, I see. Interesting.
Right? Like the amount of information that came into the market and the magnitude of that information for the impact it would have on forward returns for companies was far greater. So if you're a trend follower and you're saying, I'm constantly just going to look at the prior 12 months of returns, and if they're positive, I'll invest, and if they're negative, I'll divest. Well, the amount of information you're capturing in 2007 with 12 months is very different than the amount you're capturing in 2008.
It's like an ergodicity concept there. I mean, that's just diving down the deep hole, and that's.
No, I think
I'm gonna have to get some Pirates
bit.
Rum for that. Yeah,
I think that's a little bit. So if I had my perfect system, if there was a way for me to do this, I would say I want to measure the amount of information content coming into the market.
It's almost like changing the scale, right? I want to measure it based upon relevancy, not based upon time. In a sense.
Exactly. Yeah. You're changing your basis. So if I had my perfect system, I would be able to quantify the amount of information coming into the market. And I would say, I don't want a 12-month moving average for my trend following system. I want a 12 information units average. And whether that takes 12 months or 12 days, I don't care. I just want to measure a constant amount of information. That's really hard to come up with. I mean, you might be able to measure news and news sentiment, but what I eventually learned was this actually is a technique that's been used in high frequency trading for a long time. What they look at is they actually look at constant volume. So instead of plotting price, saying, well, what was the minute to minute bar? They'll plot bars that are relative to every 500 units of volume traded. Gotcha. Or ticks, how many ticks. And when you normalize by, 50 ticks at a time, or, $500,000 of volume or whatever it is, you get a much more normalized return path. Similarly, if you try to measure not a constant amount of ticks or volume, but accumulated volatility. Like how much is it going like this and accumulate that? And when it accumulates a certain amount of noise, you just move on to the next bar. You end up with a measure that is very dynamic in time. So really simple example, if you're trying to measure a constant amount of that variance, go pre-March 2020, and you're looking for a longer term measure, you might have been looking over 6 or 9 months for a constant N, whatever that N is. And then all of a sudden, March 2020 comes around, and that same amount of variance occurred in like 2 weeks, right? And so you would have massively shortened up. So what my trend following system did is it said, I'm not trend following over a fixed length of time. I'm changing the basis into this variance measure. It's actually called a variance clock is how the literature would talk about it. Again, I didn't know any of this was actually in the literature. This is just all stuff I sort of stumbled upon myself for the most part.
Super interesting. Yeah.
And what it ultimately does is if you look at it in the time sort of scale, there are some times when it looks like a very long moving average or long trend following system, and other times when it looks like a very short trend following system. So it ultimately ends up being a very dynamic way of measuring trends.
Yeah, that's fascinating. I guess, like, who were your influences in kind of in going down that wormhole there? I mean, like, what were the early things that got you involved, and kind of where did it end up over time? Because even when I look at my own sort of where I've gone in my investment diving, like, it is so different now than where it kind of started out with.
Well, I think like just about every individual investor, I started out thinking I was the next Warren Buffett, right? and I tried to slog my way through a lot of the tombs of value investing. I quickly learned that game is not for me, because I'm not only am I horrible at picking stocks on a discretionary basis, but I'm way too emotional about it. So I just said, okay, that game's clearly not for me. A lot of the stuff that I was attracted to reading was actually much more about risk. Back then it was Fooled by Randomness by Taleb. Yep. It was Bookstaber's Against the Gods. It was Rebenato's Plight of the Fortune Tellers, Aaron Brown's Red-Blooded Risk. A lot of what I was interested in was actually much more on the risk side of the balance sheet than the return side. I don't recall anyone in particular from like a signal perspective that I was going, these are sort of like the people giving me that insight, because I wasn't really reading academic literature at the time.
Yeah.
And I wasn't in a circle from an industry perspective where I had the opportunity to share a lot of this stuff. So a lot of the ideas I had were just sort of riffs on maybe technical indicators I was seeing online, and heavily driven by what data I could get, right? Once you sort of strike out on your own and you go to get that CompuStat data and you find out it's $120,000 a year, you start to question whether that's the data you want to use.
Yeah, that's interesting. That's like it's really fascinating how your sort of, kind of upbringing, into the industry really shape your view. I mean, just kind of summing or kind of thinking about, your whole background. I mean, you grew up in a very volatile, grew up, you came into the market in a really awful kind of volatile time. Seemed like you had this risk adverseness, for lack of a better word, at least early on, when you said, I was worried that I'd lose all my money as a college kid, and now you're reading about risk. So right. It's interesting to see how all that has framed your early development. And
it's much more embarrassing than that for me. I mean, I think it's internalized in my DNA to the point that when I was really young, my parents' nickname for me was Safety Boy. Okay. So it's like I was the kid who wouldn't go near the pool unless I had my water wings on. Like I think there's, when you talk about how people gravitate towards different parts of investing, for me, it was like the two things that were, like in my DNA was this risk aversion. And then I think there was the passion for computer science and programming. And the real marriage was putting those two together in their application to markets.
Yeah. And, you took the most risk adverse path possible by striking out on your own. So of course, of course.
Okay. There's a little gambling in there.
Yeah. All good. That's super fascinating. I mean, it just I find that when I talk to people and I just get their background and you can see the mindset, and you get these backstories, you really can understand kind of how their framework came together. Because, I mean, I've characterized investing as the act of selection. Like it's a very intellectual and a purely mental exercise, right? I mean, it takes no physical ability at all to invest. So it's all mental, and people's mental frameworks are so different, yet we're all trying to do the same thing, which is, buy low, sell high type of thing. So it's really fascinating. Um, I was just wondering, so you do something a little bit different than most people. I think people who think about investing or investing in single name stock pickers or bond pickers or whatever. You are more of, I guess, would you say kind of systems? Like, how do you kind of think about the types of trades and research that you do?
I think I have long given up on the idea that I can generate excess returns for my investors based on stock selection. Right. I don't think I can compete in that arena, particularly when we're talking about the S&P 500. I don't think I have an edge. So, and by the way, I think these are all very hard things for an investor to admit, but I think it's important to admit where, like, really take a good look in the mirror and say, where is my edge? And I think where I have really tried to create edge for my investors is thinking about portfolio structure, both in how can you holistically create a portfolio that can outperform, generate excess returns over the long run, but as well as how can you create a portfolio that's not taking on unintended risk. That unintended risk part is one that I think sort of in my mid to late 20s was a huge focus of research for me, because I watched so many of my peers in the tactical space who had raised billions and billions of dollars proceed to blow up after one or two bad tactical calls. And it became very apparent to me that some of these systems were way more fragile than they seemed, right? There was this idea that simple is robust. And so they were all proposing very simple tactical models. And as I watched them blow up, I said, oh, I actually think under certain circumstances, too simple can actually be incredibly fragile. And so I think from 25 to 30, and it's a continued vein of research for me, but 25 to 30, there was a huge emphasis on figuring out the unintended bets within my portfolio and neutralizing them through diversification. And so it's a lot more like thinking about what's the Sharpe ratio of my portfolio. What am I doing structurally that I can add potentially enhanced returns in a way that most investors won't be able to add value? And then what am I doing on the risk side to try to control for risks in a way that my peers might not even be aware they're taking those risks?
It's interesting. It's, again, it kind of goes back to the, I don't want to call it paranoia, but it's the risk management side, right? Like, can I know what I don't know? In a sense,
Right.
It's interesting, because again, it's ultimately, it's like almost like what it's the old Mark Twain, saying, right? It's like, I'm going to butcher it, but it's what you think, but you don't know, or something like that really gets you.
Yeah. It's interesting to me how it pops up in so many places. I think Lawrence Hamptill, who I'm sure you know from FinTwit as well, in the mid 2010s, everyone was talking about how cheap foreign markets were relative to US markets. And he was one of the first people to really pound the table and say, you're all missing the fact that they have an incredibly different industry composition than we have. Right. And if you adjust for industry composition, they are identically valued to US equities. But everyone was just looking at the headline, sort of cyclically adjusted PE of the index itself, without really reconciling those subtle differences. And so people who ended up investing abroad were not only taking on massive sector bets relative to their domestic investments, but then they ended up taking on massive currency bets as well. Right. And that's the sort of stuff I think people aren't always aware that they're doing when they look at what they think is, foreign equities are trading at a PE that's 2/3 of US equities. that's an attractive investment. Well, not necessarily.
That's really interesting because as we, I've been doing this for almost 20 years or so, and over that time, I've really seen the explosion of kind of the ETF and the index passive world really come onto the scene and start eating kind of the active managers lunch. There's the active managers being the like kind of stock pickers, bottoms up guys, and the passive being more of a top down analysis. As you know, Corey, I'm going to buy the market per se, and that is really, I mean, that's huge these days. And I guess and to your point is, when you're saying I'm buying the market, like the market is not abstract. The market actually is concrete. Like you are buying a market. So when you say I'm going to buy the market, I'm going to buy the S&P 500. Most people go, oh, I'm just buying the S&P 500. No, like what is that? You're buying the 500 largest U.S. publicly traded stocks. By market cap, by S&P, however their criteria,
whatever the committee's criteria is.
Yeah, like there are bets that you are making that maybe good bets, maybe bad bets, but there are so many implicit bets are unbeknownst to you by saying by making these seemingly innocuous investment decisions. Like there's no free lunch in this industry, and it's really interesting how you're trying to kind of uncover what those no free lunches are, so to speak. It looks like we're running over the 30-minute mark here, Corey. So what I'm going to do is I'm going to check out the chat here, and then maybe we'll wrap up this episode, and maybe we'll continue for part 2 that will air next week for everyone. So just kind of looking on the chat here, MA, thank you so much for your super chat donation. Again, you're always a huge supporter of the show. I appreciate it. It looks like everyone's very impressed with you, Corey, on the chat here. Nothing else. I guess there's a question here. How did your early market bets, your pre-adult investments do?
Not well.
Yeah. Yeah. No pure surprise there. So with that, guys, we are going to end this episode here, but we are going to continue. So come back in next week where we will air the second part of my interview with Corey Hoffstein. Thank you so much, everyone, and have a fantastic weekend.